The gold market is doing that thing it only does when the price on a screen stops being the price that clears the real world. Because right now, the headline spot quote is one number, but the amount people are actually paying to secure physical metal in key hubs is a different number. And when those two numbers start drifting apart quickly, that is not a curiosity, that will need the mechanism. In India, bullion dealers have been charging premiums as high as $112 per ounce over the official domestic price, after the market was showing discounts up to $12 just a week earlier. In the same reporting window, China flipped too. Premiums were cited as up to $8 per ounce above the global benchmark after being a discount of 12 to a small premium the week before. Let that sink in. A major consumer hub goes from discount to triple-digit premium, and another flips from discount to premium in the same breath. That does not happen in a calm, well-supplied physical market, and it's happening while the paper price itself is swinging hard. Late January saw gold push into historic territory, with record prints reported in the mid-5500s per ounce, and then snap back violently with prices reported pulling down into the low 5100s after trading near 5600. The point isn't the exact tick. The point is the character of this tape. When volatility rises like this, the physical chain doesn't relax. It tightens. Here's what needs to be understood. Gold price is not one price. It's a stack of linked prices that usually stay aligned until stress shows up. There's London, the big over-the-counter settlement hub often called Loco London. There's New York, COMEX futures, a standardized, highly liquid contract market. There's Shanghai, where physical price discovery can show up very directly. And then there are local markets, like India, where import policy, taxes, and distribution realities create an entirely different set of constraints. Most people hear spot and assume it means instant metal. But spot is a benchmark, a reference, a quote shaped by the marginal trade in a global financial network. The premium is what the market adds when the metal must actually move, be financed, be insured, be fabricated, be delivered, and be handed over. So when premiums surge, it's not because the crowd feels bullish. Premiums surge when immediate supply cannot meet immediate demand at the posted reference price, under the real-world constraints of that market. That's the mechanism. And it's brutally simple. If demand surges in India because buyers expect import duties might rise, people try to front-run the policy change. They want metal now, not after a potential cost increase, not after a bottleneck, not after the rules shift, so demand jumps. But supply does not instantly jump with it, because supply is constrained by imports, inventory already on shore, banking channels, refinery capacity, and the willingness of holders to sell. Dealers can't teleport fresh bars into the country overnight. So the premium rises. The premium is the rationing mechanism. It's the market saying, if you want it now, pay up. And here's where it gets really interesting. When a premium rises in a major market, it doesn't just sit there as a local story. It creates a directional incentive for metal to flow. Higher local prices pull supply, because that's what arbitrage does. But that arbitrage is not frictionless. It depends on logistics, financing, bar availability in the right form, refinery throughput, shipping, insurance, and, crucially, the willingness of intermediaries to deploy balance sheet. When those frictions rise, premiums can blow out far more than expected, even if the paper price hasn't fully reacted yet. That's why premiums often move first, and that us why the next 48 hours matter, because the catalyst isn't T-vague sentiment. It's a calendar. India guest union budget is set for February 1st, and the market is reacting to the possibility of an import duty hike. In the same reporting, India's domestic gold price hit a record 159,226 rupees per 10 grams, while jewelry demand was described as weak and investment buying was strong. That detail matters, because it tells a story about demand quality. Jewelry demand tends to be price sensitive. Investment demand can be catalyst sensitive. And when policy fear overrides price sensitivity, premiums can move like a trapdoor. Now zoom out, because the premiums aren't just about India. China flipping to a premium in the same window matters because it's another major demand center, another enormous pool of buyers, another channel where physical tightness can show up directly. Two hubs shifting together is louder than one. Now add the futures layer, because this is where the global mechanism gets tested. In futures markets, the majority of volume is contracts, not bars. A contract is a standardized promise, and in theory, it can end in delivery. Delivery is important because it anchors the paper market to the physical world. When markets are calm, the relationship between futures and spot is mostly explained by carry costs, interest rates, storage, insurance, and the curve typically reflects that. But in stress, another spread becomes critical: the spread between paper pricing and deliverable reality. And history proves that spread can explode. March 2020 is the cleanest example. That month, dislocations appeared where New York futures traded at extreme premiums relative to London, not because gold was philosophically worth more in one city than another, but because logistics and refinability constraints made it hard to move the right metal to the right place on time. Normal spreads became tens of dollars. The market priced friction. That's exactly what premium spikes are doing: pricing friction, pricing urgency, pricing constraints. So over the next 48 hours, watch the premium behavior as a signal for whether the physical chain is tightening or relaxing. If premiums remain elevated or spread, that implies stress is persistent. If premiums collapse, that implies the catalyst is fading, supply is catching up, or demand is backing off. Now, the honest part: premium spikes can be temporary. They can jump for boring reasons: taxes, shipping bottlenecks, financing costs, dealer inventory gaps, risk management at the retail level. And in a policy-driven move, if the fear to change doesn't materialize, the front-running bid can vanish fast. Price can also kill demand. When gold is screaming higher, people hesitate. Jewelry demand can dry up. Even investment demand can pause because nobody wants to chase a parabolic move into a headline. And there is always intervention risk, not necessarily dramatic, but structural levers like margin adjustments, tighter credit conditions, changes in import channels, or regulatory messaging that cool speculative behavior. From a chart perspective, after a move this violent, pullbacks can be brutal. So yes, the bearish case is real. This could be a localized premium blowout tied to budget anxiety that normalizes as soon as uncertainty resolves. But here's what those risks don't change. If premiums are rising across multiple major regions at once, the market is telling a bigger story, because local frictions can explain one spike. System-wide tightness is what explains multiple spikes in multiple hubs, in the same time window, and in a world of extreme uncertainty. The physical market tends to be the first place stress shows up. The premium is not a footnote. It is the market's confession. It's the difference between a theoretical price and a real price. Now, here's the practical framework for reading what happens next. If the benchmark spot price chops sideways but physical premiums keep rising, that is a warning that real demand is pressing beneath the surface. It suggests the chart may look calm, while the physical world is quietly bidding higher for immediate metal. That can resolve in two ways. Either the benchmark price rises to meet the physical reality, or demand gets destroyed by price and premiums collapse. There usually isn't a third option, not for long, and that's why this mechanism matters, because it tells where pressure is building before it becomes obvious in the headline price. So what should be watched, without guessing, without hype, without turning this into a prediction? Watch whether India S premiums stay extreme after the initial surge, because persistence means tightness is not just panic, it's supply constraint. Watch whether China AS premium stays positive, because sustained premiums in major hubs encourage flows and signal real demand. Watch whether spreads in the broader system start behaving unusually, because when friction shows up, the market prices it fast. And watch whether delivery and inventory signals remain firm, because physical settlement pressure is the anchor that keeps the paper market honest. None of this guarantees direction. It's a diagnostic, a way to read the market's stress level in real time. Full risk disclosure: gold can be violently volatile, premiums can compress quickly, and market structure can shift without warning. This is education, not financial advice, and any decision should be based on independent verification and risk management. But the core message is simple. Over the next 48 hours, the question isn't just whether gold is up or down today. The real question is whether the pricing mechanism stays coherent. And when it starts to wobble, the first place it shows up is not always the spot chart. It's the premium, the cost of reality, and the price of immediate delivery. Because the premium is where the market tells the truth about what it actually costs to get the metal. And right now, that truth is getting louder.